So let's talk about getting paid, because that's the one that I think a lot of people are saying, well, what do you mean I get paid? I get my $5,000 back. And so I basically put in 5,000 and I get my $5,000 back. That's not the case though. What do they actually get?
First, you get your money back, which that's a great thing about investment, getting your money back. But depending upon what state you bought it in, then you would get, in Arizona, you could get 16%. You could get as high as 18% in Florida. In Illinois, you could get all the way up to 36%. In Iowa, you could get 24%. You're kind of getting the idea. So each state, the legislature decides exactly what they are willing to pay. They are always paying an outrageous interest rate. I mean, interest rates are 1% right now. So they're paying an outrageous rate to get people to come in and do this. But for the investor, it's a perfect investment because you're either going to get paid or you're going to get the property. It's one or the other.
Okay. And so is that percentage rate, is that an annualized return?
Yes, it's an annualized return and with a tax lien certificate. Most of them are annualized, but there are states, and we haven't got to it yet, that they have penalty returns. So let me just divert a little bit. Now, I hope I don't confuse you. So right now we're talking about tax lien certificates, but let's just transfer in our brain. Let's go from the West Coast all to the East Coast. Let's go to Georgia. So in Georgia, if the people don't pay their tax, they'll also have a tax auction, and they'll actually sell the deed to the property. So you actually get the deed in your hand, but it's a redeemable deed. But no matter how long you own it, if you own it 1 day or 365 days, it pays 20% because that's a penalty return. So they have penalty returns in Georgia. They have penalty return in Texas pays 25. They could get a penalty return in Rhode Island or Connecticut, that kind of thing. So they have two different kinds of returns you can make on a tax lien certificate.
It's a lot easier than you think. It's not so scary once you know, okay, you can just ask these questions. And we turned to Ted, we turned to all his education, we turned to the coaching staff to get the questions we have answered because they're experts.
This particular property was a very nice property, and in our opinion, nice enough to actually live in. We were in it total for $11,000.
Both of those. And we rented that at $1,225 for 15 months.
Mm-hmm. Yep.
So we collected all the money back from our initial investment and more.
And more.
And then after holding it as a rental for some time, then we decided, okay, the property is appreciating so quickly.
Yeah.
Phoenix was really hot. We ended up selling the property, and the sales price was?
We had a contracted sales price of $184,000, and $169,000 hit our bank account.
One of the other questions we hear quite a bit on this strategy is, what can you get started with? Do you have to have 10,000, 30,000, 500? What do you need to get started doing the strategy?
Okay, well, people that want to start small, they can start with $500 or $1,000. Now, keep in mind, if you invest $500 and you got a 20% return for the year, you're not talking about a lot of money. So if you're investing pennies, you're just going to make pennies. So keep that in mind. And later on, we won't on this video today, but another day I'll show you about buying tax defaulted properties, and those are even more lucrative, but I'll tell you about that in the next one. Most people try to buy tax liens because they want a conservative investment. So the beauty of the investment is 97, 98% of these people are going to get paid right away. There's very small percentage, 1 or 2% are going to get the property. So people like it, and so they might take 25 or 50,000 and divide it up into a bunch of tax lien certificates.
Gotcha.
Now, once you start buying them, they all don't pay off at the same time. So you're getting checks all the time. And if they're doing it online, it's even better because the county just deposits the money in your account. So you get a text telling you get money. So you love that, right?
Right. Awesome. Yeah, we like those kind of messages, of course.
Yeah.
So is this, I mean, people are thinking about real estate, tax certificates, government. Is this complicated though to figure out?
Oh, no. This is easy. This is everything I'm going to talk about when I talk about tax liens or show people. This was all invented 200 years ago when people couldn't read and write. So this actually came from England as a wealth tax, and then they changed it to a property tax in the colonies, and then it just passed its way across the country. And each state has its own little rules about it, but it's been around for a long, long time. The challenge isn't, we're not dealing with bad people. What's happened is sometimes someone will pass away. and there's no heirs to take care of the property. So that property ends up at a tax sale because nobody pays. Other times, people just go through stress like they did in this last year, and they don't pay their tax on time, but they will pay it. So they'll pay it later. But meanwhile, you could be earning money on that tax lien certificate. So we're not dealing with bad people that do bad stuff. It's not that. It's just the circumstances. 1 or 2% of all the properties in the United States will go to some kind of tax default this year. 1 to 2%.
Gotcha. That's a lot of properties. So
yeah, it is. Oh boy, it is.
All right. So one last thing I want to make sure we cover on this this short video here, because a lot of people right now are looking at the markets. They're going up. They went down. In 2020 they crashed. They went back up. People are looking at cryptocurrencies went up and went down. There's a lot of volatility out there, and people are uncertain about the future. And you're seeing the government print money. The government is printing money like crazy. Like in the last year alone, they printed 24% of all money in existence. The U.S. has printed in the last year alone. And so we're looking at our dollar and saying, okay, how do I make sure that my dollar is not just not losing value, but also gaining value, or because of inflation, right? That we're starting to see right now. So a question that I hear a lot from people is, hey, I have an IRA or I have a retirement account, qualified retirement account, and I wanted to put it in something that's more stable, getting a higher return because I feel like I'm losing money from because of the markets and volatility and inflation in the government. So can people use those kinds of accounts, like qualified retirement accounts, to do this strategy?
All right, absolutely. If they have an IRA account or a 401k, they definitely want to use that to buy tax liens. However, if they want an inflation hedge, they need to tune in the next video, because in the next video, let's try to do some talk about buying the actual properties, because the property generally, I'm a real estate guy like you, generally keeps up with inflation. Now, I don't know if it's going to keep up the same rate, but generally, so the half of the states sell tax lien certificate. It's safe, it's secure, it's perfect for an IRA. All right, so that's one arena. On our next video, let's talk about tax deeds. Now, in those tax deeds, half of the states actually confiscate the property. They're not benevolent. They confiscate the property and then they resell it for back taxes. So let me tell you how that works. What happens is the property's worth $200,000. The people didn't pay their tax. When they don't pay their tax, they give them warning after warning after warning. And if they don't pay, the local government confiscates the property. Now, when they confiscate it, they don't want property. What they want is the revenue. So they sell it for very close to the back taxes. Now, when you buy close to back taxes, what you're doing is you got a property value, let's say 200,000. You might have bought it for 10, 20, or 30 cents on the dollar. So let's say you got it for 30 cents on the dollar. So you bought that property, a $200,000 one, for a very low price compared to the whole value. And now you've got all that upside. So those properties are for inflation protection. I tell people they should get all they can while they can.
Yeah, absolutely. Very cool. All right, everybody. So you're seeing some really cool stuff here, a really cool strategy that can really get you some good returns, especially if you have some accounts that you're kind of worried about. You want to get into some different assets that have essentially guaranteed returns. This is a very, very good strategy. So with that, I want to make sure that we value your time, Ted, and also keep this video short because we're going to do another one. So what I want everybody to do right now is keep your eyes open for the next email. We're going to actually have another video talking about this in a little more depth, a little more detail, and some more questions as well that we have as well. So with that, I want to say thank you, Ted, for taking time to do this video. This is awesome. Very good information.